it's somewhat unfortunate, but I see a lot of developers miscalculate assumptions or look at, profits on paper in one scenario and just proceed. We have in our modeling all different scenarios. We have just on the single family pro forma alone, we have 5 different scenarios understanding the bandwidth of profits. We have a scenario where we assume a 20% crash in the market, right? We have a scenario where we assume we're not even doing the horizontal construction. We're just going to sell it as entitled lots, right? The only way that we proceed on a deal and say, yep, this is one that we want to put our own money into, which we do in every single deal, it has to make profits in every single scenario. And if it does, we're comfortable that, hey, in a downside situation, we still make money. Hey, in a situation where we don't know how to do the construction, we still make money. And then of course, in horizontal, then we obviously make money too. So
I looked at that and I appreciated you throwing that in, because I think even with the 20% correction, let's walk through those numbers. If you can pull those up for me and walk through those different scenarios where, if we do see a 20% correction, because ultimately this investment is a profit share. This isn't something where it's a preferred rate of return and has some hurdle. You are aligned with the general partner, which would be Red Oak in this scenario, yourself. Walk me through these different scenarios. I think it'd be extremely helpful.
Yeah. So again, this is our standard process in every single one of these deals. And so what we'll focus on, again, it's pretty straightforward. It's low, mid, high, and high. And what's amazing is whenever we go out and negotiate with the builders, we start at high, right? We say, hey, we're willing to sell these lots at $82,500 a lot. Do you agree? And what's amazing, this is evident of the strength of the market. We have not once had builders push back on our high pro formas, right? But again, we still need to assume a range. So we have a range here of where we think we'll play. And obviously this is how we drive our negotiations. So let's not get this out to the builders. But here's a scenario where we say, okay, great. Well, what if there were a crash? And this crash, by the way, is off the low scenario. Okay. So what if we have to do a fire sale at $58,000 a lot, which would be, I haven't seen a lot that low in, 2-3 years. So we assume everything else is equal. The cost to build, the cost of capital, the cost to our investors, the cost of OpEx, the cost of engineering, nothing else changes, but just the top line, okay? And I'll spare you some of the details. It's a long P&L of line items that down.
I looked at all of it, by the way. I looked at every single
job site security. We have toilets in here. You name it, it's in here, right? We have all of our permits and entitlements and operations.
You know what you didn't do? Can I just interrupt?
Yeah, sure, go ahead. Mm-hmm.
In a 20% crash, okay, or recession, one of the things that you didn't do, and this is something that you can consider, so this makes your estimates a little bit more conservative, but from a macroeconomic perspective of looking at supply and demand, we have a recession, correction, crash, call it whatever it is you want. All of those things that go into the development, all of those things that go into the building, the materials, they should also experience a decline. Nowhere did you have that in there, by the way.
That's right. Well, again, this is why we
being conservative. That's
100%
speculating, right? But just something that I noticed that I think actually just makes
it's a great call out. Yeah. But I think for the audience, we want to keep it apples to apples. And you're absolutely right. Obviously, commodities kind of typically move and flow with the growth of GDP and obviously the output of our economy, right? So, but let's just assume that it is the worst case scenario. You can see that even in a crash, this profit still $4.4 million, give or take. And in our profit share, which is 25% to the investors, they still pocket $1.1 million in this scenario, right?
They're still going to make money in a scenario where the market corrects itself. There's always the ability to, and I don't know, Tom, if this has ever been a thought, but, to repivot. A couple of things that you mentioned was, we're looking at developing this, but I think being able to pivot based on what the market gives you. And then at that point, you can say, you know what? We'll just bring this in-house. We'll develop all this and we'll actually do a rent to own or something like that, where
Right.
you've got the ability to be flexible. Have you ever thought of anything like that?
That's a great point. So, I mean, we've already talked to the city of Seguin, right? We said, hey, here's our idea, right? Single family lots, 380, easy peasy. They're like, great. Here's a timeline. Okay, awesome. But we also talked about, okay, well, also, what if we need to build townhouses ourselves, right? And again, townhouses should be a fairly easy sell in the market. They're somewhat easy to build. You can, hammer them out fairly quickly, and they become an asset that we can sell and own, right? And keep it in-house, to your point. And we like when cities say, yes, we're open to that as well. Seguin actually encouraged it. They say, we need rentals. The demand's coming. We need cheap housing, affordable housing, and rentals. So we absolutely would entertain you doing a mixed use or the entire community as rentals or townhomes.
Yeah, you've got that ability, and then ultimately you can sell that cash flow to, there are so many institutional investors out there looking for exactly these types of assets. So I think, when you're looking at that pro forma, obviously the data, what it helps me do when I do my evaluation is ask the operators, folks like you, qualitative questions that we then can look at alternative scenarios. And I think that's extremely important when you're looking at a deal, because, that flexibility is key. If you're going to restrain yourself to only being able to do X, and now the market is giving you, and after watching Man in the Arena, and which is about Tom Brady, and I'm a bit of a Tom Brady homer, he always makes a lot of life analogies and relates them to sports. And I kind of look at an operator being able to walk up to the line, read a defense, and you're going to the best quarterbacks, what makes Tom Brady great. And I love how we're talking about Tom Brady on this real estate deal. I think it's awesome. But he exploits what the defense gives him, right? And ultimately, a great operator is going to be able to take a step back and say, what is the market giving me right now?